The Momo, or momentum trader, wants to buy exactly that, momentum. Now anyone can look at a line and see if it's going up or down, but knowing what will happen in the future is the hard part. To the Momo, there just has to be enough momentum to buy a position, have some greater full buy it off you higher. Enough inertia that they didn't buy the top. Momentum, or inertia, is the constant there. That which moves does have inertia, whether it's a ball, a spinning top, a person, or even virtual, like a market. J. Willis Wilder thought he had the solution to quickly determining this inertia. The very same who developed the RSI, parabolic SAR, and average true range. The DMI, or Directional Movement Index, was developed by Mr. Wilder and released in his 1978 book, New Concepts in Technical Trading Systems. The indicator is to gauge the overall trend of price action. Composed of two lines, the positive DMI and the negative DMI. The positive DMI is a bullish price action, or price increasing. The negative DMI is bearish price action, or the price decreasing. Unlike RSI, where the goal is to look for overbought or oversold conditions and the trader trades contrary to the data, the DMI, you're part of the trend, not against it. And so, the goal is you're looking for overall trend strength. With that, I'd like to introduce the ADX here, the Average Directional Index. ADX does not turn negative like a lot of the other oscillators you've seen, but ranges between 0 and 100, where 0 is very weak momentum, or indeed completely absent, and 100 would be an extremely strong trend. Applied with a DMI, the trader can, at a glance, determine the strength of a trend in the market. Shown here is the Bitcoin 4-hour time frame. I'll shade in the bullish and bearish DMI to make this easier to see. Using the crossover, it's pretty easy to visualize where either the bulls or the bears were in control of the market. The crossover can be traded, but using the ADX is really key for interpretation. Like all oscillators, there are bullish and bearish divergences. Here are two perfect examples right beside each other. Both show a higher high in price, but a lower high in the ADX. This is a bearish divergence. To help you visualize why this is a bearish divergence, you can see here that price decreased, but there was lower bullish direction of movement and momentum, indicating this is a weakening trend. A warning for the trader to close their long position from lower down. The ADX can also be used to determine zones of accumulation or distribution. Let's look a little bit further back. When the ADX is below 30, Bitcoin is not significantly in control by either the bulls or the bears. These periods can be used to mark price support or resistance zones for future trading. So you see, the DMI simplifies the price action, helping the anxious novice trader ignore their first red candle, or the professional Momo trader to know when the music stops. The math is also pretty straightforward. To calculate the DMI, two functions must be first created, the up move and the down move. The current candle high minus the previous candle's high is up move. The previous candle's low minus the current low is down move. So if the up move is a higher number than the down move and the number is positive, then it becomes DM positive. If the down move is more than the up move and the down move is positive, this is a DM negative. The lines shown are the 100 times EMA, or exponential moving average, of these calculations over the average true range. And the ADX is the 100 times EMA of the DM positive minus DM negative over the DM positive plus DM negative. Not to worry on the math either. TradingView has this indicator built in. It's one of the most popular and frequently used indicators for Forex and other very volatile assets, making it very useful for cryptocurrency. Thank you very much for watching, and cheers. For more indicators, please subscribe. If you have a suggestion for an indicator, feel free to write it in the comments. Cheerio for now.